Welcome to the Pro Ticker Deep Dive. Today we're diving deep into the economic forces really shaking things up for real estate investment trusts, REITs, and specifically the huge structural impact of artificial intelligence. I mean, you really have to ask yourself right now, is AI the biggest thing, the biggest tailwind for REITs since, e-commerce kicked off that massive warehouse boom? Is all this recent excitement just hype? Or is it genuinely setting up these data center REITs for years and years of solid growth?
Well, the market's already given us a pretty strong hint, hasn't it? It suggests this is much more than just a passing trend. Real estate really seems to be at an inflection point. You see, traditional sectors like office or retail, they're struggling. But the property companies directly linked to AI, to digital infrastructure, they are absolutely leading the charge. It confirms a huge capital shift is happening.
Okay, that sets the stage perfectly. So the core of our deep dive today has got to be figuring out how this AI wave fundamentally changes the whole sector structure. Our mission is really to unpack these dramatic, sometimes conflicting macro forces that are playing out and pinpoint the specific opportunities, but also the real risks that you need to be aware of right now.
Okay, let's kick off with the macro picture then, because the recent rally we saw, in the overall REIT index, it wasn't really driven by property fundamentals getting better, meaning not necessarily more leases signed or occupancy going up. It was much more about these rapid shifts in economic expectations.
That's absolutely right. That's key. The biggest immediate boost came straight from the bond market. We saw yields drop quite sharply. The benchmark 10-year Treasury fell below 4%. And that was triggered by, inflation data cooling off a bit, plus a rise in jobless claims. That basically cemented the market's bet that the Fed will have to start cutting rates soon. Right. So let's connect the dots there for the listener. Why does a potential Fed cut, or even just the expectation of one, give such a lift to the whole REIT sector almost instantly?
Well, REITs are incredibly sensitive to interest rates. Two main reasons, really. First, they use a lot of debt leverage to buy and develop properties. So lower rates mean cheaper borrowing costs when they need to refinance that debt or when they want to fund new projects, new growth.
Okay, cheaper debt. Makes sense.
And second, they're dividend stocks. That's a big part of their appeal. So when bond yields fall, those relatively high, stable dividends paid by REITs suddenly look much more attractive to investors hunting for income. It drives their stock prices up. Lower rates basically boost the present value of all their future cash flows. It's significant relief for their balance sheets.
Okay, so that's the push factor, the positive side from rates. But here's where the picture gets, well, a lot more complicated. The pull factor is the labor market. And it looks structurally weaker than maybe we thought. We got revised data suggesting the U.S. economy created way fewer jobs over the past year than the initial reports showed.
Yeah, and this revised data, it's a crucial structural headwind. You can't really ignore it, even with the potential rate relief. Less job growth overall, it translates directly into less mobility, less churn. Think about it. Fewer jobs being created means less demand for new office space because companies aren't expanding as fast. Less turnover fuels less demand for self-storage as people aren't moving as much. And just generally softer leasing for apartments, too. It's a real drag on the fundamentals for those non-digital real estate sectors.
Okay. But despite those clear labor headwinds hitting the traditional property types, the big story this past quarter was just singular. Anything tied directly to data, to cloud infrastructure, it just exploded higher. The momentum was so strong, it actually pulled the overall REIT index up dramatically, and it even managed to outperform the broader S&P 500.
That difference really speaks volumes, doesn't it?
Yeah.
Specialty REITs, data centers, and some diversified REITs, the ones holding digital assets, they were the clear winners. We saw some specific names jump by double-digit percentages. And all this optimism, it's totally based on the idea that AI demand isn't just a cycle, it's exponential.
Okay, let's break down that exponential demand idea, because I think this is where the real insight is. You mentioned hyperscale partnerships.
Right.
Just for the listener, these hyperscalers, we're talking the giants, right?
Yeah.
Amazon, Google, Microsoft. They're the main customers driving this need for more capacity. What exactly is AI making them demand that's so different from just, needing more servers like before?
It's a huge leap, not just in terms of space, but critically in power. It's about power density. So a standard server rack in a, let's say, traditional data center might draw maybe 5 to 7 kilowatts of power, something like that. But an AI rack packed with GPUs for running large language models and machine learning, that can demand 30, 40, maybe even 50 kilowatts per rack.
Wow, okay. That's a massive difference.
Exactly. So it means these data center REITs, they aren't just leasing out simple floor space anymore. They're selling reliable, high-density power, and the really intense cooling infrastructure needed to handle all that heat. It fundamentally changes their revenue model. They can charge way more per square foot, and it's driving huge capital expenditure and growth for these specific REITs.
That makes the shift really clear. It's not just about building big, efficient boxes anymore. It's about specialized, power-hungry infrastructure. And we saw concrete examples of companies riding this wave, didn't we?
Oh,
Like Iron Mountain, Digital Realty, Digital Bridge, they all surged.
yeah.
Investors are clearly betting this isn't just a blip. They see it as the foundation for a new, long-term structural growth cycle.
Right. And meanwhile, the more traditional sectors, they lag significantly. Hotels, gaming, shopping centers, mostly flat or even down slightly. And office REITs, well, they remain under severe pressure, especially if that labor market weakness continues. And we're also seeing some unique issues in certain areas, like healthcare REITs. They're dealing with some tricky lease default disputes and renegotiations with their operators right now, so some volatility there too.
So pulling these threads together, what does this all mean looking forward? We've got this huge AI opportunity, clearly, but we also still have these persistent risks in the wider economy. How do we balance those?
Well, if we focus first on the opportunities, AI and cloud demand is absolutely number one. Data center REITs are just perfectly positioned to capture this exponential growth. The challenge for them is securing the land and, crucially, the power needed for that expansion.
Okay, opportunity one, AI demand. What's number two?
Number two is that rate relief we talked about. If the Fed does cut as expected, it could ease financing costs quite a bit. That helps them manage existing debt, sure, but it also makes it cheaper to fund the, multi-billion-dollar expansions they need to build out capacity for AI.
Right, funding the growth.
And number three, we shouldn't completely forget the long-term sort of non-cyclical drivers. Even with short-term lease issues, demographic trends still strongly favor certain specialized sectors like senior housing and medical office buildings. They still have a pretty solid long-term story.
Okay, but let's push back on that optimism a bit. Even if rate cuts happen, does that really overcome the very real risks? Risk number one has to be that labor market weakness we discussed.
It absolutely remains a counterweight. You can't just wish it away. Slower job creation, less employee movement. It will pressure leasing demand for apartments, for self-storage, and especially for offices. Those sectors are kind of fighting the macro tide, whereas data centers are riding it.
And risk number two, what if inflation stays sticky? If tariffs or supply chain problems or high service prices keep core inflation from falling as much as hoped.
That's a big what if. If inflation doesn't cooperate, the Fed might not ease as aggressively as the market is currently pricing in. And that would deflate that crucial rate-driven tailwind pretty quickly, the one that's given so much relief to these REIT balance sheets lately.
Okay, let's shift from the big picture, the fundamentals, to the actual price action. How are the charts reflecting all this?
Well, the charts are pretty much confirming the fundamental story we've been discussing. The overall REIT index is bouncing back. It found solid support near its recent lows, and it's moving almost in lockstep with those falling treasury yields. But what's really fascinating is the technical strength you see specifically in those AI-linked companies.
Yeah, that strong movement suggests the big money is really buying into this AI narrative, right? Data center REITs are breaking out of these consolidation ranges, periods where the stock price was just going sideways. And they're doing it on heavy volume. That's usually a very strong bullish signal. The charts are basically screaming that this structural shift is happening now.
Right. So for anyone tracking the charts, keep an eye on the overall REIT index near that 1,300 level. That seems to be acting as a pretty solid floor for now. Resistance looks like it's sitting around 1,380. If we see a decisive breakout above 1,380, especially on high volume, that would signal the market is ready for a much bigger move upwards, all based on this new AI story.
But maybe a crucial note of caution here, particularly for shorter-term traders. Momentum indicators for those leading names like Digital Realty and Iron Mountain, they are starting to look a bit stretched, suggesting near-term overbought conditions, which just means the price has gone up very fast in a short time. So while the longer-term trend definitely looks positive because of the AI catalysts, you should probably watch out for potential short-term pullbacks, maybe some profit-taking. Okay, so to wrap this all up, to synthesize this deep dive, AI is clearly giving the REIT world a powerful new growth story. It kind of transcends the problems facing traditional real estate right now. The sheer amount of money pouring into cloud and AI infrastructure is making data centers the new must-own part of the REIT landscape. It really echoes that industrial warehouse boom we saw driven by e-commerce, doesn't it?
Absolutely. This whole transformation represents a really crucial narrative that long-term investors should follow closely if they want to capture that kind of secular growth in property assets. But, all the rapid expansion and the huge market excitement around it, it also guarantees that this space will come with plenty of volatility. So lots of action for those looking for shorter-term trading opportunities, too. It's definitely a space to watch.
See you all on the next Pro Ticker Deep Dive.